Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 3rd of June, 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, well, this week I'm going to be talking about the SP 500, the local ASX 200, and I've also got some fascinating charts showing some sentiment of the market. And I think you're going to find them really interesting to have a look at. So make sure you stick around. All right. Well, with that all said, let's jump into our first chart. So we have the S&P 500 on the screen, and what an interesting week we've been having. So I've been talking for the last few weeks through this section through here, been talking about the potential for a bounce. And it's been a little while coming, but we're finally starting to see it now. Because like the theme really has been over the last few weeks, the theme's been all about several indicators being at extreme oversold levels. And we're also seeing market sentiment reach really overly bearish extremes where we've seen in the past have resulted in markets rebounding. And we've also got that classic zigzag pattern that you can see through there from that high at the start of the year. And then we put the Fibonacci's on, and we had a key level through here. We did some measured moves, and we came up with this key region which looked like it could create some sort of an upward reaction in the market. And that's very much what we've been seeing over the last week. We've certainly got that strong rebound that the market seemed to have that potential to deliver. So let's jump over to a 4-hourly chart, because it's always interesting to look at these markets on a bit more finer detail than a daily chart. Daily charts are great, but then you look at these hourly type breakdowns that you can see some detail that you just miss when you're looking at those daily bar charts. And now, the key feature through here, we talked about this last week, we had a resistance band. So we've got some resistance through here at comes in around 4,100 to 4,200. And we can also put the Fibonacci retracements on. So let's put on the Fibonacci's from this last leg of the decline. Goes from the March high through to the recent low. And so what we have when we do that, we get what we do when we see that, we can see the markets come right up into this resistance band. So it's come into the resistance band from these previous lows, and it's come back into the Fibonacci retracement zone, so just beneath the 50%. And that's where the market stalled just over the last day or so. And what I think may happen around here is I think the market might continue to pause here for, look, I don't know for how long. It could be just a few days. But I think we could get some sort of pause as we are in this resistance region. And I think what this has done, it really has relieved that acute oversold condition that we had through here. And now it's a case of, well, what's going to happen? What's going to happen after the market sort of like settles itself down after the recent rally we've had? And what's also interesting is, I'm just going to duck down and show you one of these indicators that we've been watching. And it's the stocks above their 20-day moving average. S&P 500 stocks above their 20-day moving average. So we've come from down here where we were deeply oversold, and we're now getting back up towards the overbought extreme. Not quite there yet, but we're getting it to the point where previous rallies have stalled out. So that's one of the reasons why I think we may find that the S&P 500 does at least pause. Does at least pause around where we are now, just going to 4-hourly chart. So that's going to be interesting. And I think may happen is I think we may test higher again. So once this pause finishes, I think we have the potential, definitely have the potential in this market to to test higher and maybe get to the upper bound of that Fibonacci, maybe even beyond it. What we can do, we can, like, let's just take a couple of these lines off. What we can do, we can't fully do a measured move yet. To do a measured move, we need more confirmation of where this low point's going to be. But let's just make some assumptions. So we can measure that most recent leg upwards, then we project down. So if this were the low point, you can see the top of that shaded area just up above 4,400. Say around 4,450 would become a target. If the market were to test a little bit lower and put in a low a touch further down, well, then you get to a target maybe around 4,400. So I think that's the sort of potential that we're looking at over the next week or two. Maybe we get the market does something like, we could see something like that. That's like, who knows how it actually turns out, but that's one potential pathway where we could get the market testing even higher levels than what we've seen so far. And then the big question from that is, would that be the start of a new bull market, or would it merely be a bear market rally? Because that's the question going around the market at the moment, is like, are we seeing the start of something big developing, or is it just a bear market rally? My feeling is that it's a bear market rally. I think these bear market rallies, they're typical and they're commonplace within these larger declines, and they have a habit of like drawing people in, thinking it's a real thing, and then falling back upon themselves. I think that's probably where we are at the moment. I think there's a high chance that we will see lower levels later in the year. Like, we can't be sure of that by any stretch, but that's sort of the take I have on like how this looks. I'll show you why I think that. Get rid of that. Let's go back to the daily chart. Because when I look at this chart, and I'll look at it from the COVID lows. So let's just measure how long the bull market was. The bull market stretched for, and you can see in that blue box, it's 452 bars. And now when we measure out the decline, it's coming in so far at around 97 bars. So it's not even a quarter the length of the bull market. So from that perspective, I feel that the bear market, this bearish leg, really does need a bit more time, because that's what bear markets are all about. Bear markets really inflict pain. They're all about inflicting the maximum pain on the most number of people, and they're difficult. So this recovery from the COVID low was so not typical of how bear markets work. They tend to be more grinding, and they go on, and people just get over it and they leave the market. It has been uncomfortable, but it hasn't been drawn out at this stage. So I think there's at least more time in it. Even if there's not a lot more price in it, even if there's not a lot more to the downside price-wise, there could be, but there may not be. It could even just be a fact of drawing this out over several more months. Because bear markets, when you look at the historical average of them, they tend to last around 9 months, maybe 9 to 12 months. So this is quite short so far. And what I think we could see develop, like one possible scenario, is that we get sort of like ABC or another or a zigzag start to form in this market, where we start getting this upward bound now, the zag upwards, and then we get the other zig down, and that could play out into, like, if it followed that sort of general sort of pattern, that could take us to a low maybe in September, maybe in October. So that's one possibility, and it would actually be quite similar to something we've seen before. I'll show you an example. To go back to back in here in 2015, you can see through here we had this same sort of sharp decline. Then you've got the bear market rally, which went on for a couple of months, and then you got a secondary decline, which just took out the previous lows. And then from there, the new bull market began. corrections never play out exactly the same way, but there are particular types, and that is one type that does sometimes play out. So that's one possibility. So from that standpoint, I'm still taking a cautious approach to this market. I'm not getting excited. I'm not getting excited by this recent bout of strength, this bounce. I'm not getting excited about that being a new time to really get in there and start buying because of those concerns I have that this could still continue to play out. But that said, it's always important to know that you could be wrong. So it was always good to have these views about what you think could happen. But you've got to also understand that you could be wrong, and you've got to consider under other scenarios. And this is the thing with a good trader. So a good trader is a flexible thinker. And good traders, you find they don't get locked into a viewpoint. They don't let ego get in the way. Because I think this is a big problem for a lot of people. It's like this need to be right. So they'll have a view, they'll tell people their view, and then they'll dig in. They'll say, well, the market's not going my way yet, but it's going to be right because. And they come up with all these reasons, and ego stops them from being flexible, stops them from looking at the price action, looking at the data and making objective decisions. So you've heard what I think could play out. That would be my preferred scenario at this point. But look, I know markets don't always do what you think they're going to do, and many a time I've thought one thing and something else has happened. So another possibility is that maybe we have seen a final low. That is one of the possibilities, and we've got a 20% decline in the SP 500. Nasdaq's down a touch over 30%, so they're significant declines, and they could, by historic standards, mark bear market lows. Now, I've seen some interesting analysis through the week, which sort of does support the possibility of a bear market low. So let me just show you some of these things. So I saw this on the Twitter feed through the week, and this is really interesting. So this is showing. I showed you something similar last week, but was talking about the phrase bear market, how the word bear market often gets mentioned a lot at the market low. Another take on that is to do a search for the term bear market rally. And what you find with bear market rally is during the initial stages of a recovery, there's a lot of reports about bear market rally. So a lot of people, just like I've been speaking about now, start talking about, oh, well, this rebound is a bear market rally and the market will go down and retest those lows. But some of the times, the low's already in. You can see through all these periods where the spikes and the comments on bear market rallies are, it was after the low point, was people looking for further declines. And this is pretty extreme what we see now. There's a lot of people who are talking about the prospect of a bear market rally. So look, I do like to take a contrary sort of view to the world. If everyone's saying one thing, I do then like to look and consider the other side to that. So maybe from that standpoint, maybe this is the final low is in and may not be running back to new all-time highs, but maybe it's a case of markets moving sideways for a period of time, and there won't be any more significant losses from here. So got to keep an open mind to that. Another thing I saw was this here, and this is interesting as well. So this analysis here is showing. Well, let's start with the green section. So it's showing the percentage of stocks that have made a 6-month low in the last 3 months. Now, look at this. This is for the SP 500. So just recently, we had 66% of stocks making a new 6-month low. And when you go through how this has played out over the last 22 years, once we get up around this 60-70% mark, it typically does lead to bottoms in the market. Here's an exception where we did get up around this 66% mark, and it was a bounce before the GFC decline continued to unravel. So it doesn't mean a final low is in place, but there is a good amount of data suggesting that quite a bit it does lead to a final low. The one below is just a more extreme version in that it's a percentage of stocks that have made a 12-month low in recent times. So we don't often get up to these extremes, but most times that we do, it is a low. It is a final low. Always exceptions in these things, and there's that GFC bounce where people could have said, well, look, that's the final low. We're off to new all-time highs, but it was far from it. So you've got to be flexible, and you've got to look at the data and assess things as it's happening. And just lastly, this was interesting as well. This guy's done this. This firm's done some calculations on what happens when the SP 500 has a bad start to the year. So they've used the first 100 days. So they've calculated where the S&P 500 is after the first 100 days. So the worst 100 days in history was during 1932, during the Great Depression. The second worst first 100 days of the year was in 1940 during the Second World War. Then we have 1970 during the Vietnam War and a recession. And the fourth worst is recently, just in the last few weeks. The market's down 16.5% in the first 100 days. What they've done then is calculated what's happened over the rest of the year. So on every occasion so far, it's only a small sample size. We're only talking about, like, this is there's only 5 previous examples. So it's a small sample size, but on each of them, the market's been up. And on 3 of them, it's been up double digits, and a couple of them have been quite significant. So maybe the worst isn't yet to come. Maybe the worst is in the past. So keep an open mind and don't get yourself locked into a particular scenario. Be flexible and keep an eye on the price action, because at the end of the day, it's the price action that matters, not the opinions of, doesn't matter who they are. Opinions are interesting, but it's a price action which determines whether you make money or whether you lose money. And so, look, I think the upshot from all that is I think there's a strong case for being cautious still. But with that said, I know I could be wrong, and so I am keeping some risk on the table. I've just in the recent rally, I've tidied up some of my portfolio, some stocks which needed to go. I've sold into the rebound, but then I've also done a little bit of buying. So I'm always open to that prospect that maybe the market will continue higher. We just have to wait and see. And look, if you're getting some value from this, please hit that like button. Please leave me a short comment. Just, hey, Jason, thanks for the video. It tells YouTube that you're watching, you're engaging, and then if people are doing that, YouTube shows more people. So please do that. And also, if you haven't hit that subscribe button and the the bell notification, that also helps me a lot, because YouTube sees people are joining my YouTube channel, and it'll show more people. So it's a really big help. And if you haven't, jump over to my website, my motiontrader.com.au website, and always interesting articles and things I'm putting up. So in my resources section, I've just put up an article, the best contrarian indicator ever. And you open it up, and I'm talking about, contrarian indicators can often be the best guide to where the stock market is heading. And talk about how I'm fascinated by sentiment, because it can give you clues to the mindset of the investing world en masse. And that's what we've been talking about just now. We've been looking at some of the sentiment and trying to get into the mind of the market en masse. And here's some graphs I've used, which I've found around the traps, and which I think I can then explain and share with you. Looking at how magazine covers can be a great guide at times, and things like that. So all sorts of interesting things on the website. So come across and check it out if you haven't already. All right, now back to our charts, and let's go to the ASX 200, the Australian market. So positive developments through the week, in that we broke above 7,200, which has been capping the market over the last few weeks. So just through here last week, we've got the break upwards. So that's positive. But overall, it's really been a grind. This market, the ASX 200, is you got to say that it's making heavy work of it. It's struggling to gain momentum. And what we can do, we can put the Fibonacci retracements on this, of this leg down. If we do that, we find that we're right here at the 50% retracement where it's struggling to really move forward from. And we also now find that we're in the middle of this range. We're capped by a triple top resistance there at the top. And at the lower end, we have a support band, which has so far held the market. And we're now pretty much right in the middle of that. So I don't have a confident viewpoint on this. Normally I say, look, I've got a bias to the upside, to the downside, but it's really not a very clear market. If the US pauses and then continues to have another leg upwards, I guess from that standpoint, you'd expect the ASX 200 to have some sort of upside as well. But in terms of putting on a position here, it's neither bullish or bearish. It's right on the 50 and 100-day moving averages. It's just not a very clear market at this point, and it's really being propped up by a few big stocks, the likes of BHP, Commonwealth Bank, some of the other banks. Some big heavy cap stocks are propping up the ASX 200. Because what's really interesting, I want to show you this. I want to show you the ASX equal weighted 200. So it takes the market cap component out and it weights each of the 200 stocks equally. So let's have a look at this. And it's a completely different chart, really, or at least over the last 5 months. Just to show you how different it is, let's just put the ASX 200, the regular ASX 200 over the top of it. And you can see, so look, there's the ASX 200, which gets reported on the nightly news. So listening to that, you think, yeah, things are all pretty good in the Australian market. But then look at when you invest equally in each of those stocks in the ASX 200, it's a very different story. As I say, this is propped up by those big, heavy cap stocks, and the rest of the market has really been finding it quite difficult particularly over the last couple of months. We've had this strong move down during May, and it's really struggling to bounce over the last few weeks. And the same can be said when you look at the small ordinaries, the ASX small ordinaries. Potentially even a little bit weaker. It's been struggling. It's the big caps which are really been holding the market up. So where do we go here with the Australian market? Well, look, I think you've got to say that the trend is down. The 50 and 100-day moving averages are clearly trending lower, and the market's below it. So I always say when a market is sitting beneath its moving averages, it's vulnerable. It's not a time to buy the dip. It's not a bullish setup. It's a vulnerable setup. It's not to say that the market can't bottom here and start to form a base and work higher, because ultimately that's how a base is formed. The base will start being formed below the moving averages, but the surprises to the downside also typically happen when the market's below the moving averages. So it is a vulnerable. I think it's in a vulnerable situation. So that's why I say I think the game remains defense. It's all about protecting capital. And as I was saying earlier, I put on a little bit of risk this week, but I'm not doing much. I'm not interested in trying to buy the low. So many people, they want to try and pick the low on the market, but it's such a, it's just so much danger and so much risk with it. Look, if you're dollar cost averaging into a long-term market ETF fund, well, that's somewhat of a different game. But if you're trying to pick the low for a tactical trade or an individual stock, I think it's just a risky thing to do. I'd rather miss the beginning of the next bull market, and I'd rather wait for the moving averages to turn higher, for the price to get above those moving averages. And if I do that, I typically lower the odds of getting chopped about in a messy market or in a downtrending market like we are in at the moment. And look, until we see the price get above these moving averages, I'm not going to be in a hurry to start loading up on stocks. And remember this whole investing game it's all about being patient. Being patient is about waiting for those asymmetric risk reward setups, about waiting for the odds to be in your favor and approaching the market from that perspective. The market's not in a hurry, so we can't be in a hurry. We've just got to wait. We've got to wait for the setups. And the right setups, they will appear. They will come back, and there will be great opportunities. I don't know when. Nobody knows when. But if we watch the data, we watch the price action, and we protect our capital, and we stay emotionally in the game as well, we don't get ourselves worked up with all the gyrations of the market because we've got too much risk on and we can't sleep at night. Well, then when the time's right, well, we're going to be ready to get back into the game and ready to take those new opportunities, which invariably always come, but we just don't know when. So let's keep watching the market, watch those price action, watch those moving averages, and look forward to talking to you again next week. So thanks for joining me. It's been fun as always. I'll see you next time. Bye for now.